Welcome to The Explainer, where we take these complex business stories and just break them down so you know what's really going on behind the headlines. So, today we're going to dig into the latest numbers from Post Holdings. You know these guys. We're talking Post cereals, Kibbles and Bits, even Weetabix if you're over in the UK. But let me tell you, their recent performance was a total head scratcher. And this is the central puzzle, right? Sales volumes for their biggest products were actually down, but their profits way, way up. It just doesn't seem to add up. So let's unpack exactly how that happened. Okay, first things first, let's look at the good news for Post. They reported earnings per share of $2.09. Now, that absolutely blew past what analysts were expecting, which pointed to some really strong profitability. And it wasn't just the profit margin. Their overall revenue grew by almost 12% compared to last year, hitting $2.25 billion. So on the surface, the money coming in looked great. But that brings us back to our puzzle. If people are buying less cereal and less pet food, where is all this growth coming from? Well, the answer is hiding in a part of Post business that most of us never, ever see on a grocery store shelf. And this is where the story gets really, really interesting. You see, the real star of the quarter wasn't Fruity Pebbles or Grape Nuts, it was their food service division. This is the business-to-business side of the company, supplying things like liquid eggs and potatoes to restaurants, hospitals, these huge kitchens. And this slide right here perfectly illustrates that wild contrast. Just look at this. Profits for the food service segment absolutely exploded, up 50%. Meanwhile, Post Consumer Brands, that's the part with all the cereals saw profits actually fall by 8%. So what on earth could make the egg business that profitable that fast? I mean, it wasn't some flashy new marketing campaign or a hot new product. It was actually a crisis in the supply chain that kind of counterintuitively worked out incredibly well for Post's bottom line. The key driver, the whole reason for this, was an outbreak of HPI. You probably know it better as avian influenza or the bird flu. And this disease had a really devastating effect on poultry farms all across the country. So here's the simple three-step process of how this all went down. First, the bird flu. It wiped out a lot of egg-laying hens, which created a national shortage. And, basic economics tells you what happens next. That scarcity drove the price of eggs through the roof. And since Post's food service business is a major seller of eggs, well, they cashed in on those sky-high prices, leading to that massive 50% jump in profits. Okay, so let's shift gears now and talk about the other side of this story. What was actually happening inside the grocery store? Because this is the part of the business that was really up against it. Down the consumer aisles, the story was the complete opposite. With wallets getting tighter, shoppers were just buying less of Post cereal and less of their pet food. And the drop-off was really stark. I mean, look at these numbers. Cereal volume fell 8%, and pet food dropped by a whopping 13%. For these huge, established brands, those are really significant declines. So why? What happened? Well, it wasn't just one thing. Post's management pointed to a few key factors. The whole cereal category is kind of struggling. Competitors were running some super aggressive promotions. They're in the middle of a strategic reset for the Rachel Ray Nutrish pet food brand, and they lost some private label business. It was basically a perfect storm of challenges. So, with these two sides of the business heading in completely opposite directions, what's Post's game plan? How are they going to get things back on track? They laid out a really clear three-part strategy. It's designed to protect their profits right now while setting them up for growth down the road. It all boils down to this. Get aggressive on cost cutting, be smart with brand innovation, and be really disciplined with how you spend your money. And that cost reduction part, it's already happening. With fewer people buying cereal, it doesn't make sense to run as many factories. So Post is closing some plants to make their whole manufacturing process more efficient and protect their profit margins. Now, that third part of their strategy, capital allocation, that's all about how to best use their cash. And it presents a pretty fundamental choice. Do you spend that money buying other companies to get bigger, or do you spend it buying back your own stock, which is kind of like reinvesting in yourself? And I love this quote from their CEO, Rob Vitale. He basically explained that their philosophy isn't just about buying stuff to get bigger. Instead, they measure every potential company they could buy against the return they'd get from just buying back their own shares. It's all about making the smartest, highest return choice, not just the biggest one. So let's look at how all these pieces, the egg boom, the cereal slump, and this new strategy, how they all fit together for the company's outlook and what the key takeaway is from all this. This table really just puts it all in one place. You can see that massive 50% profit jump in food service sitting right next to the 8% decline for the consumer brands. It really is a portfolio of contrasts. And here's the crucial takeaway. That massive profit boost from the bird flu, it was temporary, a one-time event. As the egg supply chain gets back to normal, those huge profits are going to fade. So now the company is forecasting much more modest growth as it focuses on this new reality. And that leaves us with this final big question. Post is betting big on becoming more efficient, innovating in smart ways, and really focusing on value. But as we all continue to face this tough economy, will that playbook be enough to win shoppers back in the grocery aisle and get their core brands growing again? That's the real challenge they're facing right now.